Very interesting finish to a week that started off up and down and then finished with kind of a whimper on a relative basis. So I'm going to break down the technicals to see what's holding us in this area, what that means for our short-term expectations, and if that impacts our intermediate expectations at all. So I'm gonna, from a technical perspective, using the market forecast and other indicators, we're going to try to see what to expect early next week, as well as beyond as we head into an important earnings season here. And there's a dominant trend right now among these different asset classes. And we had a big breakout this week, so today's trade idea will kind of be an indirect way of taking advantage of that. So let's go ahead and get started. Today is Friday, April the 13th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Welcome to those who are watching us for the first time. Subscribe to our YouTube channel by clicking on the Market Scholars icon in the bottom right corner of the video. You can see it down there. You can click on that red subscribe button. Like today's video, click that thumbs up icon right down below the video there. That tells me that you liked the video today, you got something out of it. It also tells me you want me to do it again. So one click way for you to tell me what you're thinking there. Comment on anything that stands out to you from today's video. You have to scroll down further to do that. Join our daily email Market Outlook list. There's a link to do that in the event description down below. If you like this kind of content, you want more, follow me on Twitter. My handle's on the screen, at DavidSettle42. Like and retweet tonight's Market Outlook tweet. That again lets me know you want me to keep doing these videos, number one. And number two, it tells Twitter that you want them to keep pushing you all the tweets that I put out there. Same thing for Facebook. So join our Market Outlook community on Facebook. Like our Market Outlook post there. Again, that tells Facebook you want them to keep pushing you the stuff I put out there, in addition to all the other stuff that your friends put on your Facebook feed. We have almost 1,000 people in our group, so use the link in the description below to go and join us there. All right, well, let's start off by taking a look at the S&P 500 with the market forecast indicator, which you can see is heading up. You see how the S&P 2675 or 267.50 was a key level we've been talking about here, and you notice that that also happens to be the 50% retracement of this decline of this is a near-term decline. That's how long it was, the near-term line being below 50 that whole time. So a little bit of a divergence. The from an intraday high standpoint, divergences here on this blue line matter more on closing levels than they do on the highs, unless you have some significant candles like this here. So I wouldn't put a whole lot of stock into that divergence. The point is there's some resistance in this area, and I've mentioned that before. In fact, I tweeted it out here that it's going to have a hard time getting through this area. We've talked about this. There's a lot of selling volume right now at this point. It's not going to be easy, and we're going to need a decent sized move to get through. And again, you can also see the 30-day moving average, 6-week moving average falling down, holding it to. You see the 50% Fibonacci retracement, and the idea being that there's resistance up here, there's support down here on both sides. There's a lot more support. The support's a lot stronger than that resistance is. So it doesn't mean that the resistance is not there, and that's why I think there's a good chance that we can still kind of meander in this area before getting up above. And remember too, you also have the midpoint of the 4-week range in this area too. So it's not going to be easy, and you need a good sized candle. You need a good amount of volume to break through, and we didn't get that yesterday. We didn't get that over here. We didn't get that yesterday, so that's why we're not really busting up through this resistance right now. You can see we're getting some relatively long upper shadows too, which means we're not able to close at the highs, and that's one reason why we're not getting the near-term line into the reversal zone on this run, and why it's already come back down. Of course, we had a down day today, but the long upper shadows closing off of its highs as much as we are day after day after day, and including today, obviously, because we did close off the highs today. All those things are bearish on a near-term perspective. So this kind of shows that this really wasn't the most bullish near-term run here, and that the near-term line is confirming that. Yes, it was a slightly higher near-term low point, and in fact we have to you know, right now we're actually in the process of forming a near-term high point that's also slightly higher. So things are looking, you know, positive from that perspective, but not break this, you know, mold positive. We're still in this bearish mode. We're just not as bearish because, again, we're kind of close to the midpoint of that range, 4-week range, and there's strong support down here at the low point. The intermediate posture is bullish. The line is rising. It's just not that bullish, right? Because it's still below 50. It's once it gets above 50, that's the time that you say, okay, it's time to kick it in gear here. And obviously, by the time that happens, you're going to clear all that resistance for that to happen. So until that happens, it's a weak bullish posture, which means there's the possibility that we can vacillate a little bit at this resistance, at these resistance levels before finally busting through. Market sentiment's rolling up, but that's a long time indicator. It takes, as you can see, it takes a long time to roll over. It takes a long time to roll up too. And by the time it really got going here in mid-October, that's how far off the low point we are. So, you know, that I wouldn't put a lot of stock into that, but we also don't need that to say, okay, now we're ready to be bullish again. That's just kind of a sign. The fact that it's below 50 is a sign that this can be a good launch point for a new run, for a new market sentiment run. Whether we'll get back up to 90, you know, that we didn't expect that one to get to 90. That one was, you know, 2.5, 3 months too long. So, you know, unlikely we'll get back up to 90 again because we won't have that same kind of tax reform catalyst that pushed that. But it doesn't mean that we can't get up to 60, 70, or even close to 80. If it doesn't get above that, and we do get up to higher highs and the market sentiment fails, then you've got that divergence, that long-term divergence set up there that would be a little bearish for the S&P 500. Okay, let's take a quick look at the so to summarize: bullish, weak bullish, lots of support underpinning, right? But still, there's a ceiling that we're butting our heads up against and not able to get through yet. You need a little bit more to get through that. You can see the Dow Jones looks exactly the same way. And near-term line's above 50, but it's not really going anywhere, which shows, you know, with these long upper shadows and then the intermediate posture is weakly bullish. Nasdaq Composite, its market sentiment's rolling up too, but don't read a lot into that. A little bit of an engulfing pattern there with weak posture, a little bit more of a divergence. So there we actually did have the bearish divergence there. So which again suggests that we could pull back here in the short term to that low point. That, you know, the likelihood of a breaking through this support is low, not 0%, but it's low. But it doesn't mean we can't make a little short-term run down in the next couple of days. And you can see the Russell 2000, which obviously has a much higher divergence, and there we did get the much higher closes. You see, we also did break through that trend line and broken through the moving average, as well as that 50% Fibonacci retracement. So it's looking more bullish than, in fact, you kind of have to flip it here. I had it. You have to go from the top to the bottom. So you're hitting that 62% Fibonacci retracement. So it's looking better, and we can pull back down to this 1525 area in the short term, which would be another higher low point, you know, with that divergence. But the trend is definitely rising, looking more bullish for small caps, which you want. You want small caps to lead you off a good significant low point. If you take a look at, you know, the ETFs and how their relative strength with each other, and look at a long-term view on this. Whoops. Here we go. Remember the last significant low point we had really was the election low point. You can see how small caps really led the way higher. Before that, it was early 2016, and you see again small caps leading the way higher. You want small caps to lead the way higher off of these significant market sentiment low points. Go back to the S&P 500. And go a few more years back. So there's that last low point. Remember, IWM way off of that, and then before that you had this one again. Small caps lead the way higher off these low points. It's a good sign to see the IWM looking more bullish than its large cap counterparts. Because remember, the large cap stays more bullish longer. After, you know, IWM will start showing a lot of weakness at the end of these market sentiment runs, way before the large cap stocks do. Quick reminder here, if you're watching the video here embedded on our blog, remember that you can, let's get off of there we go, it's not so bad. You can use the full screen and the settings here to change the speed and change, the resolution. You can also like and retweet the Market Outlook tweet while you're watching. It's just right below you, so you don't have to go separately to Twitter. Same thing on Facebook. We don't get as many likes on Facebook, and the more that we get, the more Facebook shows this to everybody who follows my Market Scholars page, as well as join that community. So while you're watching here, if you just want to scroll down and click on that, again, clicks here as well as here, tell me that you like the video, that you want me to do it again, right? That's a one-click way just to give me quick feedback. If you want to join our daily Market Outlook email, you can do so right there. Also, while you're watching the video here. And of course, participate in the Market Outlook forum. We have a promotion going on where we're giving gift cards to people who participate the most in the forums. And you can read more about that here in this Market Scholars post. But the point being is, you can do so. You can be a part of that promotion by clicking here. That will take you, or you can come up here to the top, click on Market Outlook. You might, to participate in the forums, if you haven't already, you can subscribe and create a profile here. You can't, you won't get necessarily to all of our classes. The classes are for the subscribers, for paid subscribers. You can see we have all sorts of classes there, and if you can read about the classes through there, and if you want to click on one, that will take you to where you can be a paid subscriber. So you can't do that, but you can at least participate in the Market Outlook forums. You can create new topics with anything, any questions you have from the video. You can reply to any of these topics as well. All of that's fair game and would qualify you to be a part of this promotion here. So last week we were looking for the break up above the 200-day moving average for an arrow. We talked about that possibility, more likely to get that than breaking down, and we did have the arrow briefly today at the high today. 2680 was the sell-off off those highs that brought us down. Still a bullish week, and you notice again not as bullish as we could be because we're not clearing those highs. Now we've got to clear all these highs, which now also includes that 50-day moving average in addition to the 30 and the 50% Fibonacci. So there's some more short-term to intermediate resistance in these areas. Whereas the support's longer term and more significant. On the downside, you had all that volume. You have the 200-day moving average, the Fibonacci retracement support from the intermediate run here off of this August low point, as well as the market sentiment 38% Fibonacci retracement of the market sentiment from that low point. So we have longer term support here that outweighs that shorter term resistance that we're hitting up against. But that resistance is strong enough to hold us in place right now, and that's why we're not able to really get going yet, one way or the other. We're not able to get pushed down here despite all the geopolitical risk and for that matter just regular political risk that's out there. But we're also not able to get going again either, considering the strong earnings and the strong economic growth expectations. None of that. We're not able to really push through on that front either. Taking a look at the 3 green arrow chart, again, there's that 6-week moving average and the 50% Fibonacci retracement. MACD and stochastics are still both rising, both above their moving averages. But while the stochastics has crossed above 50, remember the intermediate line hasn't yet. The stochastics has crossed above 50. The MACD has not crossed above 0 yet. You notice we did get above the 17-day moving average yesterday, and we're clearly up above both of these. And the MACD, when that green line crosses above the red, that's when you'll get this black line down here crossing above 0. Hasn't quite happened yet, and that's the stages, right? There's your stages of trend reversal. That first stage is to get above the 8-day moving average and clear the 17. We've done that. Now you expect to clear above that 30. And usually we don't converge. The market doesn't converge to the 30 and then diverge up away from it. Usually we diverge away from it to the upside, break, we usually converge to the downside, and this is a little bit of a break from the norm because of how bullish we were right here. That kind of threw us off kilter there. We usually converge to the 30-day moving average, diverge away from it, and then come right back up. So this pattern you see here is usually what you see coming off a low point. So we'll see if that ends up being the case again. The expectation, after a potential short bout of weakness in the next day or two, before kicking up through that 2675 and making our way now into the top half of this range where there's not a lot of volume here. There's more potential, kind of that vacuum that will suck the price up in that area once we clear that resistance. And that resistance, there's a lot of volume there, and that's the reason why there's a lot of buyers and sellers. So the buyers have to overwhelm the sellers with a decent size range, with a decent size amount of volume, before the market is able to say, okay, now even with the potential return move back down and testing the new support, we're going to be able to hold that and break on through to the other side there. All right, today's intraday chart, a little bit of an higher high and a lower low, so a little bit of an outside day there from that perspective. So you can almost consider that almost an engulfing pattern. We didn't quite gap up above that high point, and of course we did eventually come down. The body of the candle got all the way down here, not quite below the low. We didn't close below the low point either, and that's how you get that body to go outside. But you can see the highs, higher high, lower low. A little bit of a bearish bias here because the high was right at the beginning of the day, the low was practically at the end. We did have a little bit of a bounce last 40 minutes that got you up to yesterday's low point for a kind of a resistance level. But you can see that this range, really the range this whole week, has been kind of stuck inside the top end of this move here. We haven't really moved. I mean, yeah, we got off that low point from Friday, last Friday when we talked about that head and shoulders pattern. Okay, we rallied off of that, like we were talking about that possibility there. We had a little bit of a dip Monday with this FBI rate, but that you can see that didn't last long, and it was quickly erased overnight into the morning, and we just kind of meandered from there and all week long, essentially, right at that resistance level. And if you look at the 20-day average, which now you can see here, we need to move the 4-week high down again to that high point there on the 16th. See, there's the high point on the 16th there. That's time we're going to have to move that down again Monday, and then, after Monday, so that's going to be the high for a couple of days, and that's going to move down. Then we're really going to have a tight range. And again, we usually don't tighten up ranges at the bottoms of lows, so that would be kind of a little abnormal. But, again, if we get a couple days of weakness where we kind of meander back into this 260 and get that kind of weird looking inverted head and shoulders pattern still form, maybe because we got a little bit higher high, maybe a little bit higher low point at 262, 261. If we come into that area before bouncing up, then yeah, that's going to take a few days, and by then you will be in the upper half of the chart. You see the high point there at 273 and a quarter. So you look at 273 and a quarter minus where the low point is right now, 254.67. That gives you a range of 18.6. Half of that puts our midpoint at 2. It will eventually put the midpoint. Once we move this high down to that high, the midpoint will be at 263.97. So at that point, we will be above the mid. And, again, depending upon where we pull back, right? As if we were to pull back down to 261, 262, then that would be the level we'd have to get back up above to get into the upper half of the range, which will be more bullish. And that's how that's happened. So you establish the low point, usually at the bottom of a long lower shadow. You have a wide range because of all the volatility. And as we start moving this down, we will be in the upper half of the range. And then that will allow you to, after you break through trend lines and resistance levels and all that, that's where you really start to take off. And once this moves down, see, eventually that will move down, and this will be the high point. And see, now we'll be trading a lot closer to the 4-week high point than the low point. and you'll be breaking through the high point when we get to that resistance, which will be a lot more bullish than we've been in a while. When you look at today's trading range, it was pretty high. I mean, it was relatively high. It was 3.5 points. The volume at 85 million shares traded. So when you look at that in context, 85 million. Whoops, not that chart. This chart. 85 million shares is below average, and so that pulls it. That's actually bullish. So that's not as bearish as it could be. And again, don't be surprised if we might get another day or two of some smaller bearish candles. Of course, anything that comes out over the weekend news-wise can blow all that out of the water. But absent any unexpected news announcements over the weekend, geopolitical or out of Washington, whatever, barring anything like that, you get another couple of days of a small weakness down there from a technical perspective, and then you have some more earnings starting to come out next week, as we are now thrust right in the middle of earnings season, and that can be your impetus to break you through and continue higher. See, that 3.5 point range is also below the average, and that's when these lines are dropping. That's a good sign. That's a bullish sign. We will need a bigger candle to break through this resistance with a decent amount of volume, 125, 150 in that area at least, with a range about 4 to 5 points, 3.5 to 5 points in that area. That's the kind of size you're going to need to to close up above. When you get that, then we've broken through. Then you're going to want to see those lines. And the fact that they're so high means that they got a long ways to come back down to get these low levels, which is another sign that this is the better launching point, a better low point to bounce off of than we've had in a long, long time. Interestingly, the VIX pulled back and it's pulled back down to the 17.5 level. So here's, the VIX came down today, almost 6% on the day that the market was down a little bit, the S&P. So it's kind of interesting to see that. That doesn't happen very often. Again, if we are going to get a small bout of weakness in the next day or two, we might get a bounce in the VIX closer to 18, 19 before rolling over and grinding towards 15 and 12. So again, back here where we had, whoops, too far. Back here where we were grinding on the VIX between 10 or a little bit below 10 and 12.5, expect that to be the case now between 12.5 and 15. If not, a little bit above those levels. Watch for this kind of grind to occur up here now. Which means we'll get bigger moves in the market as a whole than we were getting back here when we were just small moves to the upside all the time, day by day. Bigger moves overall, but day by day, smaller moves. You'll get bigger ups and downs when we're grinding away at these higher levels. And you can see too, whether it's higher levels on an absolute basis or lower on a relative basis. We're breaking it back into that neutral zone, that 90 to 95%. Break below 90%, and things are going to be good. Bounce back up really quick in the short bout of weakness to 1, and then roll back over and break on through. Then once you get below 90, it doesn't matter where you're at on the VIX here on an absolute basis, but once you get below 90, then you're going to be in this grind mode, and the market's going to have a more bullish posture for a while. All right, if you take a look at what's driving the price action, you can see the dollar was pretty flat today, but this geopolitical risk from the Middle East, it's driven up especially gold prices. Energy prices, too, have been driven up with OPEC and inventories and things like that, supply issues. But gold has been rallying even with the dollar flat. I mean, dollar wasn't down. It was relatively flat today. And you can see that emerging market stocks especially falling the most. If I were to take a look at which ones, here's all the biggest ones that are in EEM, the biggest holdings. You can see Brazil coming down almost 2%. Brazil's a stock in one of our classes that we were looking at adding some exposure to. And then you can also see China and Russia. Those are your two big names at least. China being almost a third of EEM, Russia not nearly as much, whereas down here you can see Mexico, another one of the ETFs we've been talking about in our classes. That one actually rallied. So, on the opposite end of the spectrum, a couple names that have been in our radar to look at, whereas Russia and China, the big names especially, really dropping pretty hard and pretty far. Again, trade wars, geopolitical issues with Syria, putting a lot of pressure on the bigger names in that spot. From an economic perspective, if I were to come over here, you can see, today we had consumer sentiment, coming down a little bit, and you also saw JOLTS job openings coming down a little bit too, and so that brought the economic surprise index down, and not as down again as we see globally. Globally, economic surprise index, the economic indicators have really been falling, and again, that's a really key point to remember, that everything is relative. And right now, things still, even with it down to 25, is a much better picture economically here in the U.S. than elsewhere. Things are looking worse, and you see that kind of being reflected a little bit in emergings. Now, you also see the develops, though, on the other hand, the developed countries, and if I were to take a look here at the developed ETFs, the bigger names in that space, you can see, you have these European countries having a little bit of a gain. Now, Hong Kong kind of proxy there for China, down just a little bit, kind of getting dragged down by those Asians. Japan, relatively flat. But everything else showing, in Europe, showing some small positive gains. Now, they've got some room to come up, right? Because if you see from a long-term perspective, they've been pulled back, and they're all starting to bounce a little bit. You can see Spain, you can see Germany, all starting to show a little bit of opportunities for some outperformance, some bounce off of these low points. So they've had a good week, especially relative to say Germany relative to the U.S. stock market. Have been having a good few weeks here. With the U.S. kind of languishing, but not necessarily overseas. Everything is relative, and that this is a relatively near-term phenomenon. Whereas before that, these European countries, and really for the last so many years, these European countries have really been lagging behind the U.S. even through the weakness that we've had early on this year. Those European countries have had just as much weakness or more. If I were to zoom out here and take a look at the week that was from a major asset class standpoint, crude oil's breaking out. Crude oil's had that breakout move. We've looked at it before in other, in other videos. We'll bring up there's your Bollinger Bands, but I wanted to bring up actually the 1040 and take a look at a longer term view here. We'll look at a weekly chart. We're getting a little bit of a breakout here. We've closed above, this high point here at 66.66 was the highest point that we had, 66.55 there, and we're closing up above that. So it's a pretty darn good bullish close with a lot of potential now to make a run up to 80 or beyond. Again, that's not, it's not like back up the truck breakout, because we're just barely above those highs. But it's a lot more bullish than we've been on crude in the last couple of months. So we've been kind of going sideways around what actually is a rising 50-day moving average up above a rising 200-day moving average. So that was your biggest mover on the week. From an asset class standpoint, you can see even with the weakness today, U.S. stocks still bounced up and had a pretty decent performance themselves, especially relative to their international counterparts. But if you look at the rest of these, you can see, remember how last week the high yield wasn't so bearish when everything else was down so much? It was a sign that we weren't so bearish. Well, you can see that it had some pretty decent gains today along with these stocks. That's what you'd expect. You don't expect high yield to keep up or to outpace when things are bullish, but you do expect it to make some kind of move. And whereas last week we had such a bearish move on stocks, but not a hardly move at all in the high yield counterparts. And we're not talking investment grade corporations here. We're talking high yield, so they can be relatively volatile themselves. They can be. You can see gold, the bounce that we had today. It's had a good week. The dollar's been down for a lot of this week. But gold had a good run early on, but not really. I mean, again, as as crazy as the geopolitical risks seem, gold right now is not telling us that we need to be too worried about things, right? So that's why I'm not too concerned. And it's, gold has its issues. It's, there's some pretty steep resistance here. Wherever you want to draw that line, 1367. I mean, we're going to have to essentially get to 1400 and above before you can really be significantly bullish on gold prices and say that we're going to have a decent trend going on. There's a lot of long upper shadows right here, at least lately at 1350, that we just can't get above on a closing basis. A little bit above there, 1353 over here, 1351, but you can see we can't really get above it and stay above it. And once we do, okay, 1400. Once we get to 1400, now you're bullish. So it's kind of like some stages there. You can start to enter in as a result. And you see stocks, there's some of the stocks in that area, like a Newmont here. You can see it's same thing. It's trying to break through that resistance. If I were to take a look at a longer term view, it's trying to break through that resistance. It's got a lot more up here above, but it's trying to break out, and it's got a good, decent trend going here, and it's had a good week. And this kind of a stock would benefit from a more extended run in precious metals, whether it's from geopolitical risks or whether it's simply from the fact that we have weakness in gold or in the US dollar as it trends lower along this downward sloping 50 and 200-day moving averages. The energy stocks really got a benefit too from the drop, from the increase in crude oil. They rallied 6%, so they've really taken off here. Technology stocks up 3.5%. That's been in your momentum play, and then there's your materials. There's your other dollar sign. And they're just now taking on. They're not at extremes. You want to see them at extremes. In fact, if we take a look at XLE relative to SPY, you want to see this at an extreme high before we really start to see some signs. This is XLE, some signs of an overbought market. So that's why, again, like from a long-term cyclical, I'm not too crazy bull market like we're gonna really be tanking into a bear market similar to 2008 again, because we're not seeing extremes in commodities. Even if I look at this USO relative to SPY, you're not seeing those extremes in those prices. Now USO is a little different because of the ETF, the way it's calculated. It comes down quite a bit, but the reality is, going back to the stocks, we're not in this mode. That was the mode that really here was the sign of the market top when we got, remember, the market really actually peaked in 2007 and started to roll over. But we had crazy bullishness in commodities that we're just not seeing yet. Now there's possibility where there's this, lower lows with higher lows. There's this, really big time divergence setting up, and things can get really bullish in that area really quickly. And that's, another sign that the dollar may, be on a run where, remember the dollar really took off right here, and look at all the pressure put on energy stocks when the dollar took off. Now you've got the dollar potentially making a run in the other direction, and you see all the potential that a bullish dollar, a weak dollar move, can have on energy stocks as well as, material stocks. See, material hasn't been beaten up as much, but a breakout above here and a breakout above this 23.23 level will be, you can see where, there's where we peaked, and then 2014 is when the dollar really took off. There's your potential for the materials. So more in energy, but you still have some potential in materials as well for some bullishness. And once you get up, once those have been bullish for a long time, then you're saying, okay, because again, inflation will push that dollar down. Then you'll say, okay, the Fed's going to be raising rates to combat that, and that's more signs of a late stage bull market than what we're currently seeing right now. Simply from that perspective. Of course, there's a lot of factors in technical analysis. You can't just pin everything on one thing. But that is a pretty big thing, and we're just not seeing that yet. And nothing's 100%, but you have to base future expectations of what you've seen in the past to know what to expect going forward. All right, so the stock I want to use in our trade idea today to take advantage of this weakness in the dollar and potential strength in precious metals as gold beats up against that resistance is gold miners. This ETF, which has been, it's relatively range bound, so we're not really looking forward to make too big of a move here. But you can see where there's resistance and you can see where there is some support. So in the last couple of years, and that's relatively tight range, you can see how it's kind of coiling there. But in the last couple of years, you've got some resistance up here about 25-ish, and then support down here at the bottom. And we're kind of in the middle, right around some resistance. You can see, getting up this upper Bollinger Band. Like I said before, you can see in the past where we've run up to some resistance around 25-ish. So we'll just kind of zoom in on this area. And there's your 25 level. So we'll usually get a little bit above that. So in this area here. Okay, well, are we going to make another run there? This time with kind of weakness in the dollar kind of helping push the way. And so where the trade we can do, because we're not quite there, right? Gold hasn't broken out. Newmont hasn't broken above its resistance. And you can see, we're not quite bullish there yet. Normally, if I were going to do like a long call vertical like we've been teaching, or even if I were to come back out here actually, coming down to this June to give some more time, because you see this doesn't move very much. It's got a relatively low in fact, if you look at here, I thought I turned that off. If you look at the range here to June 1st, according to one standard deviation move, now we're able to get up to 25. Of course, if it makes a move, things can move faster than expected. But now we're giving it some room. So we say, okay, if I were to buy a call option at that 23 right now, it might not ever move. It might hit this resistance and roll back down, and so much for that, right? Well, we say, okay, well, what if I bought that at the money, at the money-ish call option, 49 days out here, but then bought the 25 or sold the 25. So I'm gonna spend 60 cents. So buy that for 80. But then sell it for 20, so take 20 cents off, so I get about 60 cents here. But remember, this is a $2 wide spread, so that means I'm getting $2 minus 60, so $1.40 in gain. That's a pretty decent profit loss ratio, pretty aggressive for this type of trade. Where usually we're getting 1-to-1. So what if we said, you know what? I'll get into this when the spread gets up to 75 cents with a stop limit order. Now you notice the stock has to go up to 23.42, so we have to clear that resistance and get up. You can see even better here. Get back to a 1-year chart. We got to get up to 23.42 right here and clear through those highs. Now we're going to be more bullish. Gold will probably be pushing up above its highs too. That 1300 area for it. Yeah, 1350. So it's going to have to be more bullish to get that. I still get a decent reward. That's still $1.25 for 75 cents of risk. Better than 1-to-1 reward to risk. And again, I get my maximum return on this if and when it gets up to the $25 level. That's when I get the full $125. So it's like a long call option, but without the with a lower cost and without the time decay, while this thing just kind of meanders around for a while, or at least potentially could meander around, using a stop limit order to wait for the right timing to get into that trade. So as always, that wraps us up for today. I do appreciate the time that you spend watching these videos day in and day out. Let me know what you think. Remember to subscribe to our YouTube channel, like the video with the thumbs up, comment on anything that stands out to you. Remember to follow me on Twitter for more content like this at DavidSettle42. Join our Facebook community on Facebook, the Market Outlook community on Facebook, with the link down in the description below on the YouTube channel. Have a great weekend, everybody, and we'll see you all on Monday.